Want to know how to kickstart your investment journey in your 30s and build wealth for the future? Well, you're in the right place. Investing can seem daunting, especially if you're just starting out, but today we're breaking it down into simple, actionable steps. Imagine sitting on a beach in your 60s, sipping a drink, knowing that your smart decisions today are paying off. Sounds good, right? Let's dive in. First things first, why start investing in your 30s? By this point, you might have some savings, maybe a stable job, or even a family to think about. This is the perfect time to make your money work for you. Delaying could mean missing out on years of compounding interest, which can really make a difference down the line. Think of investing as planting a tree. The sooner you plant it, the bigger and stronger it can grow. Now, let's talk about assessing your financial situation. Before diving in, you need to understand your current finances. Take a close look at your income, expenses, debts, and savings. Are you carrying high-interest debt like credit cards? Pay that off first. It's like trying to fill a leaky bucket. You want to patch those holes before you pour in more water. Next up is setting clear financial goals. What do you want your money to do for you? Maybe it's saving for a house, funding your kids' education, or building a nest egg for retirement. Setting specific, measurable goals will guide your investment strategy. Picture this. If your goal is to buy a home worth $300,000 in 5 years, you'll know exactly how much you need to save and invest monthly to reach that target. Once you have your goals in place, it's time to establish an emergency fund. Life is unpredictable, and having 3 to 6 months worth of expenses saved up can give you peace of mind. Think of it as your safety net. When you know you have that cushion, you can invest with confidence. Now we get to the exciting part, choosing your investment types. In your 30s, you have the advantage of time, which means you can take on a bit more risk. Stocks, for instance, can offer higher returns over the long haul, but they come with volatility. Think of stocks as a rocket, fast but unpredictable. On the flip side, consider adding some bonds or mutual funds to your portfolio for stability. Bonds are like the steady ship built for all weather. If you're looking for a diversified option without the hassle of picking individual stocks, ETFs, or exchange-traded funds could be a great choice. They're like a basket of different stocks or bonds, giving you exposure to multiple companies with a single investment. Plus, they usually have lower fees than mutual funds, which means more money stays in your pocket. Now, let's not forget about retirement accounts. If your employer offers a 401k, take full advantage of it, especially if they match contributions. It's like free money. If you don't have access to a 401k, consider an IRA. These accounts not only help you save for retirement, but can also provide tax advantages. A critical piece of this puzzle is understanding your risk tolerance. How comfortable are you with market fluctuations? If you're anxious about losing money, you might want to lean towards more conservative investments. But if you can handle ups and downs, a more aggressive approach could pay off in the long run. Picture this. Investing is a bit like a roller coaster ride, thrilling and scary, but the view from the top is worth it. As you start investing, remember to diversify your portfolio. Don't put all your eggs in one basket. Spread your investments across different asset classes and sectors. This helps minimize risk because if one area underperforms, others may do well. Imagine your portfolio as a well-rounded diet. Variety keeps you healthy. Lastly, keep your eye on the long term. Investing isn't about making quick money. It's about building wealth over time. The market will have ups and downs, but history shows that it trends upwards in the long run. So, be patient and stick to your plan. To wrap it up, here are your key takeaways for starting to invest in your 30s. 1. Assess your financial situation and pay off high-interest debt. 2. Set clear, measurable financial goals. 3. Establish an emergency fund for peace of mind. 4. Choose your investment types, stocks for growth, bonds for stability, and consider ETFs for diversification. 5. Take advantage of retirement accounts like 401k, S or IRAs. 6. Understand your risk tolerance and diversify your portfolio. 7. Stay focused on long-term growth and be patient. Are you ready to take control of your financial future? Drop a comment below with your biggest takeaway from today's video or share your investment goals. And don't forget to hit that like button and subscribe for more financial tips. Next time, we'll dive into an asset class you might not be paying attention to: cryptocurrencies. Don't miss it.